Hello friends, in the series on the income tax cases, we try to choose those cases for our deliberation in which some trigger point to get into the litigation or to keep our grounds, whether at the time of the assessment or CIT appeal or further appeals, so that we can keep our litigation alive. Because in India it has been seen that if you are into the litigation or you are keeping your matter alive, then the government introduces some schemes in which the government, just because the assessee is in litigation, gives the relief to the assessee in respect of penalty and interest. So even if our case is weak and we are in the litigation, then we can get the benefit of these schemes, because this is the history of Indian taxation, that the assessee who comes forward and pays the tax, then the circumstances are there in which he has to pay the interest and penalty, and after paying the interest and penalty, the government comes up with some schemes like Vivad se Vishwas, etc., in which those assessees are demoralized who have paid the taxes, interest and penalty before. In the present case, we have chosen the case of section 271DA. Section 271DA penalty is imposed on the assessee for violating the provisions of section 269ST. Nowadays, this provision is disturbing a lot of assessees. The name of the case is FINESSE International Design Private Limited versus Additional Commissioner of Income Tax, and this case has been reported in 111 ITR Tribunal Short Notes 37. The matter has been decided by Honorable Delhi IT H Bench, and the date of the judgment is 2nd April 2024. In the present case, the assessee is a private limited company. There was search on the directors of the assessee, and in that search some incriminating material related to the assessee were also found. As all we know that the provision of section 269 ST talks about the mode of undertaking some transactions. The provision basically says that an assessee, if he receives amount of rupees 2 lakh or more from a person in a day in cash, then section 271DA penalty is there, which is 100% of the amount of the cash transaction. Section 269 imposes the restriction of receiving the payment of rupees 2 lakh or more in respect of a single transaction. The section also in its third limb imposes a restriction of receiving 2 lakh or more in respect of a transaction relating to one event or occasion from a person, like the marriage events. In the present case, when the additions were made, after making the additions, the assessment order was passed and the assessing officer proposed the additional commissioner for the imposition of penalty under section 271DA on the allegation that the assessee has tried to circumvent the provisions of section 271DA and section 269ST by splitting the sales bills in two or more, so that he can bypass the provision of section 271DA. And accordingly, the additional commissioner imposed the penalty. When the matter came to the CIT appeal gave the relief in respect of the transactions for which the amount has been received through banking channels, but CIT appeal in respect of the cash transactions also upheld that the assessee has tried to bypass the provisions of section 269ST and section 271DA. When the matter came to the tribunal said that the main purpose of introducing the section 269ST and section 271DA is to curb the black money by discouraging the cash transactions and by promoting the digital economy. The tribunal said that penalty cannot be imposed on the assessee under section 271 DA for every technical or venial breach. In the present case, the assessee was selling the marriage dresses and other items, and the tribunal said that on the facts and circumstances of the case, levy of penalty under section 271 DA is not justified. Friends, the purpose of discussing the case is that section 271 DA penalty is not automatic. If the assessee can prove that the transaction entered into cash was not to promote the black money, or the intention of the assessee was not to promote the black money, then the assessee can get the relief from the provisions of section 271 DA, because the purpose of introducing section 269 ST was to curb the black money. If some transaction happens by chance or by mistake or by ignorance of the provisions, and the assessee can prove that there was reasonable cause for receiving the payment in cash, or the identity of the buyer and the seller is well established and both the persons have taken that amount into their income, then section 271 DA penalty is not a straitjacket formula that the assessee has received some income in cash in violation of the provisions of section 269 ST. So in every case, the penalty under section 271 DA should not be imposed. At the end of this video, once again I am repeating the name of the case. The name of the case is FINESSE International Design Private Limited versus Additional Commissioner of Income Tax, and this case has been reported in 111 ITR Tribunal, short notes 37, and the date of the judgment is 2nd April 2024. Thank you, friends.